Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes or so here on Options Guide TV. Today's date is Monday, February 12th. Here's hoping that your square paid off in your office pool for the Super Bowl. The Chiefs are the winners once again. It's the headline hasn't changed much over the last 5 years. But it was a great game. I hope that you are recovering well after that. So this week, we still got earnings going on. We haven't really hit the retail earnings, and I really don't consider earnings season to dwindle until we get NVIDIA. NVIDIA is the last of the Meg 7. They're going to be announcing on February 21st is the next time that's the next big earnings announcement. But this week, we have Lyft announcing earnings on Tuesday, Coca-Cola, Robinhood, nothing too exciting. I don't really think I want to play any of these earnings announcements this week. We're going to be doing a few of them when we get into the retail earnings. Obviously, we'll be doing something on NVIDIA. Thursday, we do have Coinbase, and crypto's been interesting. Bitcoin is bouncing back towards new highs once again, just like the market. S&P 500 index, the 5,000 level, really thought it would take a little bit longer for it to break through that, but we played our skip strike butterfly until all the way up until the end. We were 1 day short of hitting a home run on that skip strike butterfly trade, but it was a winner approximately 5 weeks in a row where we just kept targeting that 5,000 level with the center of our butterfly on that trade. If you got out on the open on Friday, you did fine. And also this week we have DraftKings. Considering we just had the Super Bowl, it'll be interesting to see how they're doing. They're going to be announcing on Thursday, and then Roku TV. Those are some of the kind of interesting earning reports that are going to be happening this week. So I didn't want to continue our weekly trade in the S&P 500 index. We were targeting the 5,000 level, and we have blown through that level. Real strong day on Friday. I was actually fairly surprised to see how strong we were breaking through that big round number. Now, the overnight session or the pre-market session in the futures, there's been a lot of the market still looks strong. Let's put it that way. Who knows where the market's going to go from here? So I would not want to be short the market by any means. Still want to stay bullish in the market. And we're kind of just hanging around. I kind of expect today to be a very boring day. So if you were doing a zero DTE options, one of the things that I would maybe look at is doing a 1 day short put spread or even a short call spread. I'd feel a little bit more comfortable on the short put spread side of things. And I would do the exact opposite of what we were targeting last week. I would be looking to sell something around the 5,000 level, below it, hoping that the market could stay above the 5,000. Because now that we broke through it, I mean, I'm hesitant to say this, but you would think that would be an area of support on the downside for the market. But we haven't been there that long. We just broke through it on Friday on the open. I think we opened at 5,005. That would have been the moment that you wanted to get out of that skip strike butterfly, and that would have been a profitable trade once again. But it wouldn't have been a home run. It wouldn't have been would have been better if we would have just hung out around 5,000 for a bit, because our strikes were 49.90 and 5,000 was our center strike, and then our risk kicked in at 5,010. So anywhere above 5,000, it kind of hurt us a little bit. And if you hung around all day long, you really got burned, which I didn't expect that, but you would have if you would have hung around all day. But I don't know why you would have. on the open. We broke through our short strike. That's when you close the trade. We've said it many times. On skip strike butterflies, you don't let them, especially on big indexes, you just don't let them fly through the short strike and just keep hurting you. A little bit like a short call spread. If I'm in a short call spread and that market flies through our short strike and ever gets to your long strike on a short call spread, you close it. Just don't even think about it. Just close out the trade. Don't look at the graph and say the Fibonacci hit the Bollinger Band that bounced off a moving average. Just close the trade and move on. You got to stop the pain. You can't let that max loss happen in those positions. And between the strikes on your short spread, you still got something left, usually in your protection trade, in the option contract that you bought. So closing it out before you ride it all the way to expiration is usually a good thing. So that would be my trade. If I was going to do a trade today, I would probably look at a Wednesday expiration in the S&P 500 index, and I would look at a short spread in that SPX trade. Now, with that said, I do want a couple of days to see this shake out. I want to see exactly where the market is going right now on the overnight. Didn't really see anything to hint that it was going up or going down. Kind of expect a dull drum day today. I still think we need to establish where the market wants to go next. So I have the paper trading portfolio in the TradeHawk software. And you might say, hey, Brian, you're talking about the SPX and selling a short spread. Why aren't you just showing it to us? Well, in the paper trading platform on the TradeHawk software, which is awesome, it really tracks the it looks exactly like the normal trading application, except that you do not get quotes on indexes. Quotes on indexes aren't free, and the paper trading platform is free. So it's just that simple. I guess we could look at the SPX. But what I really wanted, or the SPY, I'm sorry, that's one way that I could approach that. But I wanted to talk a little bit about our portfolio. So let's run to the paper trading application inside the TradeHawk software. Let's pull that up right now. And here we see our portfolio of deep in the money option contracts. So with the SPX hitting a new all-time high, breaking through that 5,000 level, it's fairly obvious to guess that our portfolio is doing well. If it's not, well, we're doing something wrong, right? I guess you could be in a lot of speculative stocks. There are some stocks that aren't doing, some areas that aren't doing as well. One of them is energy. It's a little odd, but the commodity prices in general haven't been strong. But most of the marketplace is doing well. And what I'm showing you here is we have a fairly diversified portfolio of deep in the money option contracts. We own 4 Google options. Our big one is actually been NVIDIA. We own 3 of those. We bought a Lilly option contract with the intention of adding some more to it, but Lilly has done well. Lilly announced earnings and it actually went down after earnings just for a second. We did a skip strike butterfly in Lilly that worked out, and that but I want to add a few contracts to the Lilly position. Home Depot is going to be announcing earnings, so I'm going to wait until they announce earnings before we want to add a few there. But today I would like to take this Lilly position, and I think we're going to buy a couple more of these option contracts. We want to try to keep everything fairly balanced. Not all the features inside the paper trading app work quite the same as they do on the real application of TradeHawk. But I'm going to start using some software to try to keep track of some of the calls that we have sold. We already had a position in that did really well. Caterpillar has been a strong stock, and we actually got pegged on a short option contract. So let me pull up Caterpillar real quick here in the charting side of the portfolio. And you see that Caterpillar has made just a strong move. Let's actually move it out more days. Let's go 2,000 days. Okay. So you can see the strong move. Caterpillar actually has had a little bit of volatility because we see the 200-day moving average here, and we have the 50-day and the 20-day. But we the it once we broke through this 200-day moving average, this was all the way back in February. We came crashing right back down. We ran up to 260 all the way down to 210. And there's been chop, but one of the things that stayed consistent is the lows were higher on the way up. So here we come down, we hit a low. Once again, a big move up all the way up to 290, come back down. Then the low was a little higher the next time around. Came through here, low is a little higher. So that's the sign of a solid company, solid chart showing that we were moving higher, but we got called away right around in this area, right around that 290 level. I think it was actually right about here. So we, when you have a deep in the money call option and you're selling shorter term calls against it, inside the options playbook, we call that the fig leaf. Some people will call it a leveraged covered call. There is a alternative to just doing covered calls on the stock. But the big thing about a covered call on a stock that you own, where you sell a short-term call against it, and you get it taken away, oh well, they just take your stock away. But in our portfolio of deep in the money option contracts, if they call your stock away, if they do that, then you're looking at they call it away. You don't own the stock. So that's where we actually got the name the fig leaf is, because you're kind of covered. You are covered as far as the brokerage firm is concerned. There's no additional margin requirement on that trade. But you have this long-term deep in the money option. If you get assigned on a shorter term call, you can't just give up your stock. You can't just say, oh, go ahead and take my stock. You got to do something with that position. And if you have a deep in the money longer term option, you probably still have some time premium left in that option contract. So what we did on the Caterpillar position was we just closed it out. We sold the long option and we bought to close the short option contract. Now, I'll look for another stock that we can add in the industrials like Caterpillar. If Caterpillar were to, they had a solid earnings report, move higher again. Don't know if I'm that excited about buying it up in this level and going back to our original position. But if we could come back down and trade within this range, because there's a lot of volatility, I would think about buying it back, maybe somewhere around the 200-day moving average. If that did happen, I wouldn't have any problems with that. I could set an alert to hit that. If it hits that moving average, right, it'd probably be around 270 or so. I think we'd be happy to re-enter our position on Caterpillar. Okay, so that was our position. Now let's go back to the TradeHawk software. And here we have Lily. So today we're going to take this position. We're going all the way out. We still have 340 days. So we have over a year on this trade. I would have liked to actually I would have liked to actually added to this position before the earnings happened. But one of the things about buying deep in the money option contracts too is that if you're doing this, you are going to, if you're doing this trade around earnings, you're still buying an option. And even though it's a longer term option, you're still going to be paying juice. You're still going to be paying volatility. On the longer term options, implied small swings in implied volatility can hurt those option contracts because there's so much time premium going out over a year. Even though we're deep in the money, we're buying a deep in the money high delta option contract. So if we do that trade, you prefer to wait till after earnings just because we're buying it for the long term, and there's no reason to deal with the pumped up implied volatility around earnings. And another reason why we don't have any call options on any of our positions, and it's mainly because all these companies have announced earnings. I would definitely not want to sell a call option on Nvidia, and thank goodness we didn't do that because they're announcing earnings. So if we did, we would have got pegged on Nvidia, and there would have been really hard to try to roll that option contract. Schwab did announce earnings, so here's my trade for today, and all that we're really going to look at, and then maybe I'll pull up that SPY. We've got a little bit of time, so I will go and look at we'll add this position to Lilly. We will sell a call on Schwab, and then we will and I'll look at the SPY as opposed to the SPX. I'd rather trade the SPX, and I've talked about that before than the SPY. But we'll look at maybe selling a short put spread around that 500 level below it in the SPY, and it will be a very short-term trade. And I do see we have a question. If you have any questions, please feel free to put them in the chat box. If you are on the Tradier YouTube platform, we can try to address them. We want to make this as interactive as possible here on Options Guy TV. What periods are the moving averages on your charts? That's the first thing and I'll just use JV, the initials on the question. One of the moving average periods that I like to look at, and some people look at a little bit of shorter ones, but the one that I always have defaulted on my chart is a 20-day moving average, a 50-day moving average, and a 200-day moving average. And I just use the simple moving average. So whenever you get your ducks in a row, whenever you have the 20-day above the 50-day, above the 200-day, that's usually a sign that you have a strong market. Your stock is doing well. If you can get them to line up accordingly, it's a sign of a good market overall. Obviously, the 200-day, especially like in the SPX, is fairly important. I think it's a level that a lot of people look at. You'll see the SPX bounce off of the 200-day quite often. So on a lot of overly watched, highly watched indexes and stocks, I think the 200-day moving average really plays a part. So the CAT example, you consider the simple as a reasonable support to enter a long-term position. JV, you read between the lines there. Yes. I like Caterpillar in general. I just think it got a little fluffy. Position got taken away. So if I'm just looking at an area like down here when we hit that 200-day moving average, that wasn't bad. We did break below it in the 200, and it kind of got a little scary there for a little bit. I apologize. Let's catch up a little bit. I was talking when the chart wasn't up. So if we do look at that, you can kind of see that there's some level of support. It's still fairly volatile in the way that Caterpillar moves, but yeah, you just kind of look at the 200 days. It's a fair spot to be able to buy it within that range. I definitely, with this strong spike up and being so high above the 200-day moving average, I really don't want to go back into that Caterpillar position. If I was buying a stock to hold forever, I wouldn't worry as much about where I was getting in. But when you're dealing with option contracts, I want to pick my price, my area of buy-in a little bit. I want to be a little bit more picky about where I'm going to jump into those positions. All right. So we're back to the strategy. This is fine. Let's go over to the portfolio. So everything's doing wonderful. The Nvidia position by itself, we should really just sell and we'd be done for the year on that. 320 strike call option. We're way deep in the money. We got 3 of these positions on. Going into earnings, I could actually see, because we have option contracts, I think I'm a long-term hold on Nvidia. I could see the market selling off a little, and it did their last earnings report too. They knocked it out of the water. They've been knocking it. They've been hitting home runs every earnings report, but we did see them announce earnings. Stock did make a good spike up. It was really struggling to get through the 500 level, and then it bounced back and it came down, and it was a great buying opportunity. I think we actually added a couple of these deep into money calls when that happened. I think that's when we added to the position. But with that said, I could see selling a little bit of the. I could I could see selling one or two of these before that earnings. So we might do that. We might do that and see if there's an opportunity to try to buy it back. So we just had such a good run. This position is up 80 grand since the start on it. So I definitely could see selling off some of this. You don't want to get slaughtered by an earnings report, because I think that I don't think it necessarily if it's bad, obviously the stock's going to get beat up. But even if it's good, I think it's going to be an opportunity for some people to take some profits. The stock is up again today. If I looked at it, I think NVDA, I think it's up again today at this point in time. Yeah, it's up 16. It's up another 2% today. 738. Just a second ago, last earnings report, they were below 500. I do remember that. All right. So let's do this. Let's add to this position on Lilly. So Lilly, we got the 520 call options. We're going to buy one more. Market on this is 240.68. This is a paper trading account. So unfortunately, it's kind of hard to work orders because they're not in live markets. So if you're splitting the bid and ask, it's probably not going to get filled. In the paper trading app, it's definitely not going to get filled. But it makes it a little tougher to do that. So we're going to go in and we're going to try to buy one more, and let's put it in at 243, and we'll send that one to the floor and let's do two. Let's add two to our position here. Multipliers there. We got to go over here. 1, 2. All right. And this will be our order that we're going to put in for the day. Adding to the Lilly, send order for long Lilly call 520, expiration 1/17/2025. Are we going to send it? Yes. Boom. So that order has been sent to the floor at a limit of 243. It's 20 cents below the market. I don't know if the paper trading app will fill it at that price, but I'll make sure that it gets filled today. Let's go ahead and look at Schwab then. Schwab's been hanging around 63, 64. Actually made a solid move today, up another 2%. It was around 63 is where I was considering maybe selling some calls on this position. But let's go and look at the option grid for Schwab. And they already announced earnings. When did they announce? On the 17th of they were usually the financials are they announce at the beginning of earnings season. So Schwab was a part of that, and they already announced earnings. So I'm not as worried about Schwab. It's not as volatile as Nvidia. It's really hard to sell anything on Nvidia at this point in time, even though you're going to get a lot of premium for it. So we'll go out 11 days. I like that number. Now, if I have a stock instead of that deep into money call option, I'm probably going to look at that March expiration, which is 18 days away. So in this one, we're going to look at the February 23rd expiration, 11 days away. I always want to err on getting less premium. Oh, well, it filled. That's nice. And you can, well, I guess my head's in the way there, isn't it? Let me unlock this and I'll show you what's going on. Okay, so we did fill on that trade at the 243 level. That's nice that we can actually fill between the bid and ask here. Oh, it came down. It came off. All right, so the ask actually moved on us inside the paper trading platform. So there you go. Usually, if you're in a paper trading platform, the ask has to hit your limit price in order to get a fill, and that's what looks like happened to us here. Okay, so now Schwab. We're going out 11 days. I really want to sell something around the 16%, and that's only 28 cents on this one. I think I'm going to have to go to the March 1st. I really don't want to go out 18 days, but 28 cents is a little bit too low, right at the one standard deviation move. Yeah, we got 48 cents on it. So we're going to sell this one. All right, so we're going to sell that 68 strike call. We're going to have to watch it. That's 18 days out, almost 3 weeks. That makes me a little nervous, but once again, we don't want to get assigned on these things. So we're going to have to roll that position if we get that scenario in. So here's going to be our paper trade here. Let me move this up. Get this up. Charles Schwab, 64, 67. We're looking to sell 168 strike call with the March 1st expiration. Limit price of 49 cents. The mid is 49. Nice tight market, 48 by 51. We'll put it in at 49. Let's just hit 48. Just make sure it fills. And we're sending an order to sell a call, 68 strike, March 1st expiration in Charles Schwab. The answer is yes. All right. So if we go back to our portfolio, you can actually see in here we now have 3 contracts in Lilly. Our cost basis would have moved on this, and but we're still up 10 grand on that position, up 80 grand on Nvidia, up a grand on Schwab. Still like that trade. And Google came off after earnings a little bit. Google's struggling with the AI scenario. The company's not very good at talking about what they're doing, and a lot of people feel like they're falling behind, in particular to Microsoft, and worried about their search. Google still basically is the king of search and has a lot of data to back that up. So I feel like they're going to come up. They're going to come out with something in the AI space. I don't think they're just going to ignore it. And if they do come out with something good, I do think you can get a pop in the underlying stock in Google. All right. So I did promise you, didn't I? I said we would do. We got 3 minutes left. Now, this isn't, I don't know if I'm going to call this an official paper trade because I didn't really think very much about it. Just kind of brought it up matter of factly because I kind of feel bad that we're not doing our SPX trade this week, honestly. I'm going to have a little bit of separation anxiety. So let's throw in the SPY and let's look at a short spread below that 500 level. All right, so here's 500. The market is at 502. Kind of, let's take a peek at the chart in the SPY because it doesn't trade exactly like so the new high was around 480. That would have been probably where the SPX was close to the 5,000 level because this is where the previous high was at. So we could probably sell something around. Let's look at the 495 real quick, like 495. Yeah, you're bringing in $1. You go down to there, you can almost get. So we'll do like 50 cents on this 495. Let's see if we sell this one, and we'll go 4 points, and we could maybe get $1 here, and we'll buy this one. And pull this back up. Scroll this down. All right, 64 cents. Yep, that's what we're going to do. All right, this will be, I'm in the paper trading portfolio, but I can send the order, but I don't want to screw up my portfolio of deep into money calls. But here is a trade. What expiration do we got here? Oh, we don't want to do that. There we go. Want to do a couple of days. Okay, so the month right now is the 16th is the Friday, so the 14th will be the Wednesday. Let's see what we're getting for that. I doubt we're going to get 64 cents anymore. Hold on. I like the 490. Yeah, that was too good to be true. 500 here for. Okay, so we could go here in here 498. 96. Yep. So let's clear this out. We're going to go 2 days, short and sweet. Sell the 498. Buy the 495. 39 cents. Yeah, all right. I mean, that's not bad. I'd like to get something closer to 50 cents, but we only got 3 points of risk. And let's see what the 94 is at. Look at this one. 4.94. Yeah, 46 cents. I think I like that better. Let's the unofficial paper trade. We're only going to do a 2-day trade. We'll be back on Wednesday. So by showtime on Wednesday, this trade should be close to finish. I really expect the markets to just hang right around this 502 level. It's a little bit of a scary trade. We're 4 points away on the downside in the S&P 500 index, but that is 40 points in the index. That's doable, but we only got 2 days to do it. Like that would be less than a 1% move, obviously, in this underlying. We can do the math real quick. 40 divided 4 divided by 502. We're talking about an 8% move, or almost 1%. 0.008% move to the downside. And yeah, it's a little bit of a scary trade. So we're going to put that on for 46 cents just so that we've got something to watch. We'll come back to Monday's show for Options Guy TV, 11 o'clock Eastern time. And yeah, be safe out there. Please click subscribe, ring the bell if you're on the YouTube platform. Make sure you get all of the alerts. Please tell your friends about it. And we will continue to add to our paper trading portfolio of deep in the money option contracts. We'll look to add, well, we got Home Depot earnings coming up here. We'll probably wait for Home Depot to announce earnings, and then we'll go out and sell another call against that position. And of course, the NVIDIA position has done well. So thanks for coming, everyone. And we'll see you this Wednesday at 11 o'clock Eastern time for the next edition of Options Guy TV.